Hi, welcome to Academic Market Insights. I'm Dr. Russell Rhodes, joined by Dr. Larissa Demiak. This is going to be the first video in a series where we basically go through the basics of options, not necessarily a full option course, definitely not academically oriented, because we've already been discussing how a couple of them are a lot more trader speak than academic speak, which I think is useful in the world. But in this one, we're really just going to introduce options. We're going to take a look at the very basic option strategies. And before we get going or after we're done, if you like what we've done here, please hit the like button. Please subscribe if you haven't subscribed to be able to watch all. How many of these are we going to do?
Probably like
12?
14 or 15.
14. We keep coming up with more topics.
Yeah.
We're gonna be doing this until 2026. That's a joke. We'll get them done in a month or so. So yeah, make sure you subscribe so you become aware as the new videos pop up, and intermixed with those there will be videos about things that are going on within the markets, etc. So with all of that, I am going to hand things over to Dr. A and chime in as needed.
And please feel free to ask as many questions because I think
Yeah.
that's really, or at least I think it's valuable.
Mhm.
Um, and I was thinking about this particular session. If you're a graduate student, the amount of material we're going to cover would probably be covered in your first class in about 2 or 3 minutes. And so we're taking the time to actually go through and say, okay, this is what's really going on. Particularly if you're a grad student, and we will get into some of the modeling and the other fun things that, or at least I think of fun things. But we're also going to step through and say, okay, this is what all of this means. And to Dr. Rowe's point, we're also going to talk about how does it come up in the markets itself, because there's sometimes this huge disconnect from what you're doing in the classroom, what you hear in the markets, and how these connect. And part of it's because when you're in a class, you don't have the time to really step by step, methodically go through the things that we're going to go through right now.
No, absolutely.
So, one of the first things we're going to start off with is discussing the difference between a long and a short position. And it might not be intuitive. And if you don't know, it's a very challenging thing when your instructor starts saying, well, you go short, blah, 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 blah. You're like, what the heck is going on? We're going to talk about calls and puts. And we're going to also briefly mention that all of these options, because we focus so much on equities, but there are options on a tremendous number of asset classes. So I don't want, Dr. Rowe doesn't want you to get this idea that it's only equities. There's a
Mhm.
whole world of derivatives out there that you can model. When I was at the bank, part of my job was modeling fixed income products utilizing options and creating tailored products for our top clients, which is kind of cool. Well, again, cool if you the way I think of it. Uh, so what does it mean to be long? And being long really means that you buy the asset. Your goal typically is to hold that asset until the asset rises in value. And I'm putting out there the idea of buy low, sell high, because when we look at shorting, we're going to be doing the opposite. Okay. So again, we're just buying the asset, and that's what it means to be long. And the reason why we call it long is because we are playing the long game and we think that the asset's going to rise in value. Dr. Rowe.
Yes. I was just going to say that yeah, you mentioned the short thing. Um, I taught a derivatives class for undergrads, and I think 4 or 5 weeks in, I used the phrase short, and I'd been using it all along. And somebody finally said, "Can you explain that a little bit more?" Yeah, I think coming from industry as we both have, the thought of selling something and then buying it back in the future, it's just pretty intuitive to us. But to a lot of people, it's not. And I like that we're starting with the stock, with being long and short the stock right off the bat, just to give people an idea that you can sell something and then repurchase it, hopefully at a lower price in the future.
Well, and it's funny, typically in the classroom when I do this, the first lecture I do an arbitrage example, but I'm using
Mhm.
forwards contracts, not options. And part of it, I say, well, you're going to go short. And students would look at me, and it took me a while to realize they didn't understand that we're selling something that we don't own.
Yeah,
It's
yeah.
not just a straight sale of a asset, but it's actually selling something we don't own. And that's
Mhm.
hard sometimes if you're not familiar with it to wrap your brain around.
Mhm.
So, and this is something that's important to me because we look at profit loss diagrams of calls and options. But let's talk about an asset that we're more familiar with so that we can get comfortable looking at these types of charts. This is a long stock. Okay, so profits, let me grab a, a pen. Profits up here and losses are down here.
Boo.
Yep, we don't like loss.
But it happens.
It does happen. And we need to
Mhm.
be able to see visually on the graph where it happens. Our break-even point, and this is going to be intuitive, hopefully, is the price that we paid. So when we are long any asset, the most we can ever lose is the amount that we paid. And that's not true for if we're short. It's not
Mhm.
true. We have some combinations. But when we're long the asset and only long the asset, the most we can ever lose is the amount we paid.
Mhm.
Our max loss, and then is the price that we paid. So if the stock goes up to 50 and then drops to zero, the most we still could lose on this position is $15. We might have paper loss, like there's this idea of what's called paper money, because
Mhm.
if we have this gain, let's say it does go up to 30 and we don't take it, right? Then that's what's called a paper gain. So it's just a gain on paper. And then in that case, we would have a theoretical loss. Yes, Dr. Rowe.
What did you mean by take it?
Ah, yes, good question.
I knew what you meant, but I
Yeah,
think a lot of, but I think probably a couple of people. What do you mean by take it? So just
that means actually
and I will do that periodically. So.
good. That means to sell the position. So if you're not selling those positions, you're not actually realizing those gains. So if you bought this stock for $15 and you hold on to it for 40 years and it's now trading at $300, you still haven't gained any true capital. It's you have it as an asset and its asset value. But if it goes to 300 and then the market collapses the next day and it's trading at 10, you now have a loss of $5. So realizing those gains, to realize the gain, you actually have to sell the position. So the good question. Now, selling short. This is selling an asset that you don't own. Okay. And the first question is, well, how in the world do you actually do this? If you are selling short in equity, you will go to your broker and put in a short sale. Your broker will then borrow the asset from another client. Okay. And when you then you take the asset and then you sell it out in the open market. There's a couple of risks embedded into it because the person who owns the asset could always want it back. So you're in a danger of you sold the asset short the market goes up in value, you now have to repurchase it because the owner of the asset wants it back. You're going to have to repurchase it at the market price. But your goal is that you sold it short, the asset declines in value, then you buy it back at a lower price, realizing that difference between the price that you sold it and the price that you bought it back at, and that's what you're going to gain. And when you buy the asset back, you're replacing the asset to the person you borrowed it from. So it's a lot of the mechanisms that we don't necessarily think about, but that's really what's happening behind the scenes. And when we talk about options, it's very important to understand what it means to be short because it's also called writing. So shorting and writing can be thought of as synonymous words, right? And when we want to get out of an options trade, we don't sell that option. We write another option to, and I'm drawing a blank on the word, to counteract the initial position.
Mhm.
Okay. So they become canceling contracts then. And that's something very important to think about and be very mindful of when we're talking about options. Those are some of the mechanics that go behind it. And again, when we're selling something short, our goal is to sell high, buy low, and understand that this is an asset that we don't actually own. It's also very important because it generates a cash flow. So when you sell that asset into the market and you're going to receive that cash, this is a way of generating cash that you might not have. It's a way of generating leverage, meaning that you have more ability to actually buy other assets with. So we utilize short options to be able to do more in our portfolio than we would normally be able to. So let's take a look at our P&L diagram. Again, profits.
Nope. Oh, you're right. Yep,
Okay.
you're right.
Losses. I panicked there.
What?
I thought, oh no.
What? No, I just
So our break-even point is the price that we sold it. And now we're going to have the opposite for our max gain and our max loss. So our max loss, unlimited. This is a risky position to put on. Our max gain is the price that we sold. We could never make more than $15. And I'm going to put Dr. Rowe on the spot. Why can't we make more than $15?
because stocks can't go below zero.
Right. There's a natural boundary.
Yeah. And I do want to. I when I went nope, that I and you had to think twice about it. That's really for everybody's benefit.
Okay, good.
Because there's so much, and there are a lot of things that we'll go through today that are just not automatically intuitive. And the profits, if something goes down, is not automatically intuitive. And you even had to think about it for a second when I messed around with you a bit there.
Right.
But really, the point was that my point was it's not intuitive. Everybody needs to think about it. There are situations where I stepped away from the option market, came back, and was very, very, very vigilant with respect to the trades I did and the things that I was talking about, just to make sure that I was 95% sure, but I always wanted to make 100% sure of the things that I was thinking about. And then the maximum loss is unlimited. Theoretically, it is unlimited. My classroom display, or my classroom way of making people remember that one, is if you sell short and things go tremendously wrong, you're going to lose the house, the dog, the girlfriend, and then the wife. Actually, I think the girlfriend would go first, but you're gonna lose you can potentially lose everything. So when selling short a stock, you're going against the tide. Stocks do rise over a long period of time. That's not saying you can't make money shorting. It's just very difficult. And part of it is that the actual potential gain versus the potential loss is typically the potential loss is always over 100%.
Yep.
Your potential gain can never be more than 100%, even
Nope.
if you pick, Enron and it goes bankrupt. So.
And having said that, if you see in the market a uptick in the amount of people who are shorting a stock, it is worthwhile to take a look at what's going on fundamentally with the company because of the risk. Those who do put on these short positions are usually much more diligent about really understanding the fundamentals of the company. There's a couple of key ratios out there, the short float, that you can take a look at and really understand what the market thinks about this. Even if the company, the stock price is going up, if you start to see an increase in the number of people who are putting on shorts, that's something to take a look at.
It can definitely be a red flag.
It's a red flag.
Yeah.
Okay. This is one of my favorite things to talk about. What is an option? And Dr. Rowe, you will have to bear with me with my lovely story. And I did mean that pun, the Chicago Bears. So
These weren't your seat. Were these your seats?
not for the game that I'm going to talk about.
Okay, good. Because man, those are terrible seats. Go ahead.
Well, they are.
Yeah, they're terrible. So,
but and I like this picture because it's been so long since you get physical tickets.
yeah.
So these were legitimate tickets that my sister and I had a long, long time ago. I think it says 2009. So a long time ago. Let's talk about this. So an option gives you the right, but not obligation. So when we think about tickets to the Chicago Bears, what are the three things that we can do with these tickets? Well, we can exercise and go to the game. These tickets guarantee us a seat. Okay. What else can we do? We can sell these tickets, right? We're not obligated to actually go. And the third thing we can do is we can let them expire worthless. We don't have to go. We're not contractually obligated to go to this game. So I'm going to have a dramatic retelling of the Chicago Bears story. My sister, our number one fan, had bought tickets to see Green Bay and the Chicago Bears. Now, Green Bay and the Chicago Bears usually play the last game of the season, which is in January. For those of you who have never been to Soldier Field, let me tell you, it's always cold. The Chicago Bears have what's called Family Bear Night, Family Night. It's at the beginning of August, and it always coincides with Lollapalooza. If you've ever been to Lollapalooza, it's either raining or unbelievably hot. So you walk in to Soldier Field and you're sweating. You see all the babies, and they're all decked out to their finest. They are super, super cute babies. You get into Soldier Field, and all of a sudden you can feel the 20-degree drop. It is no longer 90 degrees out. Okay. So fast forward to January. It's going to be a tough game. Okay. So my sister buys these tickets. She's got 4 tickets. The Bears have a chance to make it to the playoffs if they beat Green Bay. So, Dr. Rowe, what do you think the value is of these tickets? More or less than the face value?
Very, very high, opposite of what they would be if the Bears were 2-13 going into the final game of the season.
Exactly.
And it's also a bit weather dependent. That's the other factor.
Oh, wait. There's more to the story.
But the weather would not matter in this case.
Dr. Rowe, don't spoil the punchline for me.
I'm sorry.
There's more information that I'm going to trickle out.
Okay. All right. Yeah. But just based on the piece of information that you've given me,
yes,
I would say that you probably could make a couple of house payments based on selling the tickets.
So
how's that?
Aaron Rodgers goes on the DL list. Okay. So he's not going to play at this game.
Mhm.
Now, what do you think happens to the price of the tickets?
Probably like what happened to the WNBA All-Star game tickets when Caitlin Clark said she wasn't going to play.
Well, wait, wait,
But
wait.
maybe not as much.
I
But
would say
you think they went up because people thought the Bears were going to win?
yep.
See, here's my assumption is that there are a lot of, unfortunately, and we both know this, there are a lot of Green Bay fans in the Chicago area. I know, but they're part of the supply demand. Don't get upset about that. They're part of the supply demand. And if all of a sudden Aaron Rodgers is not playing and you're a Packer fan, and I'm not going to talk about the weather yet, but just in general, do you really want to go watch your backup quarterback get beat by the Bears, or do you want to make a house payment?
So
I so
appreciate the honesty that you're coming out of this, but I
uh-huh.
don't like it.
I'm being more logical than you are.
I again, I
Yeah, you're falling in love with the underlying stock, which is the Bears.
I know,
But
which is
yep,
a problem, something you should
yeah,
not be doing if you're trading options. Now, a
exactly.
couple days goes by, we start to get the weather report. Um, it looks like it's going to be freezing rain. And my
Okay.
sister had tickets, I think, if you're looking at Soldier Field, the second row down from the top.
Yeah, that's my favorite section.
Oh yeah.
So yeah, you can overlook. There's shorter bathroom lines. Go ahead.
Yeah, yeah, exactly.
Yeah.
It's pretty intense. So now with the freezing rain, what do you think happens to the value of the tickets?
Now they dump.
Now, on
Yeah.
Friday, and the game is on Sunday, Aaron Rodgers comes off the DL.
Upside earnings surprise.
The tickets actually plummeted in price.
Oh, really? Because now they're wow.
We've got the weather, we've got Aaron
Wow.
Rodgers coming off, and Chicago Bears fans were like, "We're
Uh,
not." They're
Option trading is hard.
yeah, and uh,
That's
so
funny.
my sister tries to sell them.
Uh-huh.
Okay, she's negotiated. Lots of people are negotiating with her. She
Uh-huh.
was offered, and I was like throwing this in. It's irrelevant, but I like throwing it in. She was offered Chicago Blackhawks tickets. One of the
So,
big negotiating points that people kept asking her was, does it include parking? Because
yeah, yeah.
Soldier Field is expensive.
Yeah.
Sh- She was able to finally sell them at face value. So she made no money, but lost no money.
And lost time.
We happily watched the Bears lose on that
Uh-huh.
Sunday in our own living room with our own beer and our own fire going, and we're delighted.
I
So
can
again,
imagine.
lots of information coming that's impacting the price of those tickets. And that we're going to have a whole section or a whole session devoted to that volatility and that importance of that volatility to the price. And so
Mhm.
we're seeing even in a non-equity arena that as information comes in, your price is going to fluctuate. And whether it's Caitlin Clark or seeing the Bears lose once again, and don't
Yeah.
tell my youngest son, because he's a huge Bears fan, argues with anybody who tells him that they're no good. It's, I feel like I've set him up for a lifelong heartache, right?
A life of pain.
Life of
So
pain.
so you had the option to
We have,
sell if you didn't like the selling price and you thought maybe you'd change your mind at the last second, you could hold on to the option. If you decide not to go, it expires with no value, or you could exercise the option and the value is going to the game.
yeah.
There
And
and the
some,
price of the option was all over the place because there was all kinds of information coming out about the game day experience.
right. And something we don't really talk about too much with options, but there is this idea of a sunk value,
Yeah, yeah.
or sunk costs, pardon me.
Mm-hmm.
And in our case, going to Soldier Field freezing might not have been worth even after the money had been spent. And sometimes with an option, if you don't want the position and you really just don't want it in your portfolio, it's okay to let it expire worthless.
Or salvage $5, but
Yeah.
which a
Well,
lot
it's
of
a little
people
bit
do.
easier to salvage the
Yeah.
$5 in the financial markets. Okay. So we have two different kinds of options. It's very binary. It's either a call or a put. And our call gives us the right to buy. Our put gives us our right to sell. And what I like about this slide is it really focuses when you are the seller. Remember, when you're sold, you're selling short because when you write the option, you're not necessarily selling something that you own, you are writing a new contract. In that contract, it is not an option, but a contractual obligation. So if you are a seller of a call option, you're contractually obligated to sell to the person who's buying the right to buy. If you're the seller of a put option, you're contractually obligated to buy from the person who bought the right to sell. Okay, and this is something, if you're in my class, I always ask a multiple choice question on obligations, and students, I would say 40% of the students get it correct, and the other 60% miss this point. It's very important to understand if you sold something, you are contractually obligated. Okay. Also, I'm going to put Dr. Rowe on the spot on this.
Oh,
When
well.
did, or you have a question?
No, go ahead. I just wanted to chime in, but go ahead. Go ahead.
Well, I
You're going to
wanted
let me
you to
talk in.
chime in
Mhm.
about when calls came into the market versus when puts came into the market and why some of that or what took puts longer to be
Oh,
introduced.
you're talking about the history where SIBO launched in, gosh, I want to say 73, 16 stocks, none of which exist today. I love that. The last one was General Motors, I think was General Motors. But the SEC approved call options, but did not approve put options. So they allowed, and call and put options did exist for years, where you could go to a brokerage firm and they would create a put or create a call for you. So you were able to trade these things off exchange. The SEC's thinking was they didn't want a speculative instrument out there that would benefit from a stock going down. But and we'll talk. I know we're going to spend a good half hour to an hour on put call parity and arbitrage pricing, et cetera. But you could create a put type payoff by combining the underlying stock and underlying a call option. And that was becoming a very popular trade. So they finally, they finally, after 3 years of arm twisting, were allowed to start trading puts on the exchange. I think everybody had some buttons that said trade puts, be an American, or there's nothing more American than puts, or whatever. But yeah, the put options were not allowed until about 3 years after SIBO launched call options. What I wanted to chime in on is I think you know the answer to this one, but do you know who the biggest seller of puts on a pretty regular basis is out there?
I don't know.
He's old and lives in Nebraska, and I'm writing a
Ah,
book about him.
yeah, I
Yeah,
know who it is.
Buffett will take a look at and I'll, what, let's table that, and when you talk about short puts, I'll chime back in on that
Okay.
one. Okay. Okay. I don't
Yeah,
want to jump too far ahead on that.
because we
So
will get to short puts today.
yeah.
And again, one of the reasons why we're doing or taking our time with this material is if you're sitting in a grad lecture, you would have covered all of this material, and it's easy to get lost in some of this. I was talking to and I know I've said this story before, head of research over at the CME group. We were talking about teaching options to undergrads, and the gentleman said to me, "Well, options are really easy." I thought, well, you've been working with options for over 40 years.
Yeah.
If you've never seen these before, they're not nearly as intuitive dis, so to speak. So we want to take our time with them. So this is a profit loss diagram with a strike price of 15, okay, and a cost of $2. So something we haven't talked about is what the strike price is. The call gives you the right but not obligation to purchase the underlying at the strike price, and in this case it's 15, by a maturity date. So these, similar to the Bears tickets, there is an end point. And once that end point hits, if you've done nothing, they will expire. Now, we'll have, I think in session number 3, we talk about moneyness. And if it's the option is in the money, your broker will automatically execute for you. So you don't have to make a decision regarding that. And again, that'll be in session 3. But for right now, just know that if it has value, it's going to be in the money. So let's take a look at, and again, be very mindful, profit, loss, and something I didn't put before. This axis is the asset value, the underlying value. So we can see we have a natural barrier of 0, because as Dr. Rowe pointed out, stock can't go below 0. We're infinite, okay? So there's infinite possibility for how far the stock can go. Intuitively, that's definitely true. Realistically, is it going to go infinite in the next month, week, day that you're holding the?
Hopefully.
Probably not. Uh, but that's still mathematically possible.
Mhm.
So our break-even point is not the strike price. It is the strike price plus the cost that we paid for the option, which in this case is $2. And that cost is going to be associated with what's called extrinsic or time value. So as the option gets closer and closer to maturity, that cost is going to shrink. Okay. But that's our break even. It is the strike price plus the cost. In this case, it'll be $17. The most we can lose, and again, because we are long that option, is the $2 we paid. It is not the $15 that would be the case in a long stock. It is only $2. And again, similar to the long stock, we have unlimited gain. What this graph doesn't show you is that if we compared the long stock compared to the long call, our long call has a $2 drag relative to the long stock. So if the stock goes up to 30, if we were long this underlying stock, we would have a gain of 15.
Mhm.
But if we're long the call, we'll only have a gain of 13 because we paid $2 for the option. Okay. So this is the profit loss diagram of our long call. And now we have our short call option. So we're going to put our P and our L, and then I'm also going to label this axis A. And I'm doing this because when I teach the class, I actually have the students put up this entire graph for all 6 positions. And Dr. Rowe, you'd be surprised at how few students actually get that correct. It's just
No,
one
I
of those
wouldn't.
things that if you don't have it like purely memorized,
Mhm.
ingrained in your heart, right? It's very difficult to actually be able to do some more of the fun things. So it's one of the
Mhm.
reasons why I require it. Plus, you and I both know that working in the markets, when you're in an interview, they're going to ask you questions to find out how much you know.
Oh yeah.
You don't have your notes. You don't have it's one of those things you just have to know this.
Right.
And for all of these diagrams, I make the students put everything out. And part of my hope is that when they're in an interview situation, that they have the opportunity to say, yeah, I know this, I can draw all these out, I can talk to it, and hopefully they'll get the job. So when we are short the call option, we have a diagram. Again, it's going to look like the reverse of that hockey stick of our long call. Our break even, and this is important to me to really highlight here, is the same break even point as the long call. And that's going to be the strike price plus that premium. And again, we're using the same numbers. So it's a $15 strike and a premium of $2. I'm going to jump ahead to our max gain. And this is the amount of money that we're going to take in when we are selling short this option. And I want to also emphasize that this is a cash flow that we receive immediately. Okay, we don't have to wait until the end of the contract to receive this contract. As soon as the contract is sold, we're going to receive it. Our maximum loss is considered unlimited. A small point, if you were to put this position on and not have any other positions, it's considered naked. We don't really talk about being naked the long call because that's just a bullish position. And we're not worried about it because we have a defined risk of $2 loss. But here, with that unlimited loss, we're in a very dangerous situation where you could have tremendous amounts of loss. As Dr. O put it, you could lose everything, right? This is very similar to you can lose your house, you could lose your dog. I'd be very upset about it. We're hopefully going to adopt a turtle. You might lose your turtle. This is such a risky position that some brokers won't let you put it on. Okay.
And
Go
yeah,
ahead.
brokers all have different rules, but they'll have different permission levels with respect to the type of trades you're allowed to do. And, even though this is session one, short call and short put are both strategies with uncovered or naked short calls and short puts are positions that most brokerage firms don't want individuals to put on. I actually, and I'm not the end all be all, but I've been trading options for 30 years. I don't want the ability to naked sell options. And honestly, I just don't want the ability to do that because those aren't the kind of positions I want to put on. And I don't want there to be a mistake in my account.
Right.
No, really, where I don't want there to be something in my account that I'm a little concerned, that I didn't mean to be there. And then all of a sudden our $15 stock is bought out at 45.
Yeah.
you
Yeah,
know.
and I have a
So,
story when we get to our short puts.
okay. So,
Yeah. Okay. So differences between the long call and the short call are max profits, are max losses. So they're reversed. The same thing, it's the same for our break-even point. And that's something that it's hard to really wrap your mind around. And when we get into the third session, we talk about moneyness. Moneyness doesn't change if you're long or you're short. And that's something also that can be a little challenging to think about. And again, a difference is that the ability to have that option versus a contractual obligation. So that's something very important when we think about the difference between long versus short. Okay.
and both sides of a futures trade are obligations. And Dr. A and I met when I worked at SIBO and I would do tours for college groups, and she brought a group over. And the first question that I would ask a college group to figure out what level I should talk to them at is what's the difference between an option and a future?
Yeah.
And it's basically rights and obligations. If you buy an option, you have a right. If you sell an option, you have an obligation. If you buy or sell futures, it's an obligation.
Yes.
But if students knew that rights versus obligations, I could take it up a bit. If they didn't, then it was comparing buying a call option to owning a stock or something like that.
It's when we talk about in the derivatives class, we go through forwards and futures.
Mhm.
One of the examples I like when we're presenting arbitrage is you can create these contracts if an arbitrage opportunity exists, where you're contractually obligated to receive that difference or that arbitrage profit, and that's something I think that's important. Is whether or not you can actually lock into those profits. And sometimes the way the contractual contracts work, that's not necessarily always the case. You can still collect the arbitrage, but you might not be contractually obligated to receive it.
Yeah.
Okay,
Yeah.
our long put, profits, loss, asset value. And again, here we're looking at the profitability increasing as the asset value decreases. So this person has the right to sell at the strike price, and that strike price is 15. So if the option or the underlying is trading at 30, we would rather sell at 30 as opposed to 15. But if the option is or the underlying is trading at 5, we'd rather sell at 15 than at 5. Okay. Our break even is now going to be the strike price minus that cost. And in this case, this option cost is $2. And that becomes the maximum loss of our position is that $2, the price that we paid, because we are long this position. So it's an interesting way to think about it. We're long the position, so the most we can lose is that $2, but we are still betting that the asset value decreases. Okay, so they seem like almost contradictory. So we've got the benefit of the short stock without that huge downside risk. It's pretty slick. Our maximum gain is going to be the strike price minus how much we paid for it. So very similar to when we talked about that long call, if we were to layer on a short stock here, we wouldn't receive the entire amount. We would always have that drag of the price that we spent. Now, Dr. Rowe, I'm going to turn it to you. You had a
Mhm.
tidbit about a certain
Oh,
gentleman
it's
in
it
Nebraska,
was it's selling,
Oracle.
but it's
Pardon
selling
me?
puts. We're gonna do
Selling? Oh,
selling put. Yeah, he
okay.
sells puts. He definitely doesn't buy them.
Well, let's look at selling puts because
Okay.
I also have a story about selling puts. And you can correct me where if I go astray in the story. Okay.
Hmm.
So again, profit, loss. And we can see in this diagram, our profit has a much smaller window than our loss, but that's okay. Our break-even point, again, is our strike minus our premium. So our break-even does not change. Our maximum gain is the amount that we sold the option. Okay, so we receive that cash flow immediately. We have the ability to use it. And the most we can make on this option is $2. Our maximum loss then is that strike minus the cash flow that we had coming in, which is from the price that we sold it at. Okay. And I'll tell my little story first, and then I want to hear about the Oracle. So, and I don't know that I've actually discussed this story with you, so I'd be curious what you think about it. And I've been telling this story for a long time, and it's not my story, so I might be telling it wrong. So I'd also, if there's a mistake, let me know.
Okay.
Uh, my buddy was uh, was trading, and he noticed that deep out of the money put options on a company called Taser were expensive.
No, I worked at a short selling firm, and that
Okay,
was one of our biggest stocks. So go ahead. Yeah.
so he starts selling
Yeah.
these deep out of the money put options. And then let's be very clear that the next part, this is going to be a news item. Um, he was trading, he had sold a bunch of these, and then there was a gentleman who died
Yeah.
from cancer,
Yeah.
which then caused the stock to plummet. And all of a sudden, he owed a substantial amount of money. And this was, to your
I'm
point, this
sure.
was out of
Yeah.
a personal account. So all of a sudden, he was had difficulties, and that's a different story. But I get if you see, and we're talking now again about other terms, deep out of the money puts. So these would be puts with maybe a strike price of 2 or 3. And am I
The
saying that
stock
correct?
was like a $10 stock. It
Yeah.
wasn't, yeah, it wasn't a very
So if
expensive
these
stock.
are, and when we're thinking deep out of the money, um, am I saying this correctly?
Yeah. Yeah.
Yeah,
You're
okay,
saying
good.
that you're deep out of the money. I know we usually say deep in the money, but I usually say way out of the money, but it's the
Way
same
out of the
thing.
money.
If you're selling a way out of the money put option, you think there's very little chance I'm going to get run over.
Right. Until
This
the
is
unthinkable
run
happened.
over. Yeah.
Right.
What you have on the slide is run over. Yeah. And it does happen every once in a while. My
It does happen.
so Mr. Buffett, what I'm going to ask you a question that's like a lead into what right or obligation do you have if you're short a put?
You are required to, let me see, buy
Yep.
at the
That's when I'm
stage.
teaching options. If I say, okay, so you're shorted a 15 put in the classroom, I'll automatically say, which means you have the obligation to buy at 15. I automatically want, that's what I'm trying to do with my students. So let's say this stock's trading at 17, and Buffett and Charlie, before he left Earth, they run a bunch of numbers and they decide that they think that they would be buyers of the stock at 15. They would
Mhm.
sell put options,
Yeah.
and they wanted the stock price to come down.
Hmm.
And if the stock price didn't come down under, if the stock was below 15, they would be required to buy the shares at 15. So they're buying a stock that they find long term desirable at $15 a share. If the stock is not below 15 at expiration, or they don't get assigned on their obligation to buy the shares, they get to keep that income.
This is
And not all of it, but a good portion of the cash that Berkshire Hathaway has on hand is the result of selling put options. And I've got a great example, a multi-year example of them doing this that we will definitely do a video on.
yeah, that's a
But that
great.
Mr. Derivatives are weapons of mass financial destruction. He said that about over-the-counter derivatives, not
Yep.
listed derivatives. So when you tell people that I always get pushback, but he said, well, yeah, he said it, but if you read the whole letter from that year, he's talking about over-the-counter derivatives. He's not talking about listed ones.
And at the time, I believe he said that in 2002, maybe 2003. So this is
He's Yeah, it was before the financial crisis.
before the financial
Um,
crisis. And we had these new securities coming out that people didn't really understand the
yeah,
risk and reward profile. And again, with any new asset class, unless you really understand it and understand, again, the risk reward profile, understand the
yep,
underlying assets,
mhm,
it could be used very, very dangerously.
yeah,
And we've
no,
seen that
absolutely,
in history, right?
yeah,
I think we're wrapping up.
we
Uh,
are.
and again, differences would be our max profits, our max losses, the obligation versus the right. And something that's the same is our break even point. It does not change whether we are long or we're short. And with that,
Ooh, look at
I
that.
know we conclude really just the basics. What is a call? What is a put? I'm not entirely sure of the length of this video, but it takes a bit to really understand the differences. And as
Mhm.
we build through these lecture series or these sessions, we're going to be able to see in more and more detail the differences, how they're used, how they're priced, and understand just the basics of the intrinsic versus the extrinsic value. And then once we have that done, we can start getting into some of the really cool, fun stuff. So with that, we say thank you so much for joining us. We loved having you here. If you have any questions or comments, please send us a message. You can leave us a comment. You can check us out on our website. We have a Twitter account, or if you would like to send us an email, we're very open to it. Thank you so much. If you like this video, hit like. And if you want to join us for future videos, which we encourage you to do, hit subscribe. Thank you.